Okay, we're all set. And let's see here. Let's make sure that this is going through. Okay, for some reason the live is having a bit of it's a little sticky for some reason. It just doesn't want to initiate. Here we go. Okay, the first time it came with an error. Okay, we're good. Okay, just bear with me, folks, here. I'm just organizing my screen. Okay, perfect. Okay, as I was teasing Ashim a little bit at the beginning, saying that I know that the tax topic, it's always a very exciting and motivational topic, right? No, of course it isn't. But I'll tell you one thing: is having your taxes properly organized is absolutely critical. And we were, in fact, Tammy and I were talking to Bill and Linda this weekend as we were driving to London, and our goal here is that there's multiple series that we're doing. Tonight we're going to be talking about taxes and how you can benefit. Even in the U.S., you can remember that Ontario, we're common law, just like the United States. Things may be very little bit, even in Quebec, which is based on Europe in France. But again, it's very, very, very similar. And the thing is, Ashim is absolutely. I'll just read his bio in a second here, but he's absolutely amazing. And the thing that you guys have to understand, to come across people like that, um, you know, it was actually by chance. I wouldn't say by chance. I guess by design, because Tammy and I, as you know, we're affiliated with the Eric Worre. And with the Eric Worre, we were one of the mentoring, and he says, "Okay, I want you guys to mingle and talk to each other and share what you guys do." And there was a gentleman there. What's his name again, Tammy?
Rakan.
Rakan from. I know that he does a lot of business in Dubai, in the Middle East, and he's in Ontario, in fact, in fact, neighbor to where we live here. And he was mentioning that in fact, I was asking him, what, as a Canadian citizen, I said, what do you use as your tax person to deal with all your taxes? Because it does require someone that understands the Canadian laws, but in the same time, that is quite familiar with the network marketing environment. Because if you have the wrong accountant, you can lose thousands of dollars dealing with the wrong mindset. And that's when we were introduced to Ashim. And the fact is, through Ashim, then we were introduced to his partner, Craig, who owns BG Wealth, who also, I believe, is a partnership with Ashim, which that's the next segment is, okay, where do I park my money? If I make money. And again, folks, you don't have to make millions of dollars. You can make very modest income, compounded with the right environment. You can end up really well. And that's one of the things Eric was saying. It's not about making the millions of dollars a year. We all thrive for that, but it's also knowing where to place your money and how it compounds. So at this point, I want to introduce Ashim, and I just want to read his bio. It's actually phenomenal. Ashim has over 15 years of senior management and business development experience in a broad range of industry. Ashim brings a wealth of knowledge to his clients. I can testify to that. He champions any entrepreneurial mindset and provides out of the box business and tax solution that helps client to grow their business while keeping more of their hard-earned money in their pockets. And Ashim's knowledge extends to in fact, Canada, U.S. taxation, corporate, small businesses, consulting, solution. In addition to his tax knowledge and business planning services, Ashim's client also benefit. I can testify to that from his extensive experience with financial planning. I think at one point he was an auditor for the government of Canada. So again, he knows his stuff. Planning and goal setting. Married with a beautiful young family, Ashim understands that having an effective tax strategy is imperative to gain financial freedom. Ashim is passionate about teaching his clients and how to grow both personally and professionally. So Ashim, it's a real honor to have you here on board. Let me just bring you up here so everybody can actually see you and meet you. And I want to thank you because I know that you're super busy. You do have a lot of clients and you're dealing with high profile clients and so forth. And Tammy and I really care about our team and we want them to be exposed to the same kind of environment that we're exposed to, and for them to make a decision, to have the best possible solution to deal with their taxes, especially in network marketing arena. So,
Thank
Tammy
you
was,
so much.
yeah, absolutely,
Thank you
Ashim.
so much
Tammy,
for
is there
having me.
anything
It's
else?
an honor.
Thank you, Ashim. Appreciate you here.
On a personal level, I'm just going to share the experience that we have because for me, relationships are very important. But he really dug into why we wanted to, create our wealth or have what it is that we're looking for, because we gave him our numbers on what we want to accomplish, and he really dug into the why, and it just makes you even more passionate about what you're looking to do. But you could feel his passion with you. It wasn't, and I know I didn't share that with you, Hashim, at all, but normally you just go in and you get this done, and okay, that's done, and you kind of move forward. But he's amazing at really understanding where you're at, and he shared some great things with us. And so far, we're really excited about the future with working with Hashim and his team. Your team is amazing. They're very diligent in
They're really good, yeah.
following through, and they're fantastic. So thank you for everything you've done.
Certainly. So,
Awesome.
Ashim, the floor is yours. You're co-host. You can share your screen, the whole 9 yards.
Awesome.
And it's being recorded. So back to you, my friend. Thank you for joining us.
Okay, thank you so much. That is a bio which is a lot longer than I'm used to. Quite frankly speaking, I find bios a little bit boring. I find tax more interesting, and I'm a lot more passionate about it. And a lot of times when I say that, people say, ew, Hashim, that's disgusting. And I say, you know what? Somebody's got to do plumbing as well. So somebody's got to do taxes as well. So nobody likes taxes. And, and I know that we're here for an hour. I don't plan to talk for an hour. I know it's evening for most of everybody who's listening to it right now, so I'm gonna keep it short and sweet. Try to get your brain spinning in the right direction, and that's the goal for today's presentation over here. So, as Chris said, I've been working with them for some time now, and we really, lack of, and this is one word that I actually learned from the direct sale marketing industry is holistic. And for lack of better words in the English vocabulary, at least that has come across me, we take things quite differently. It's not just, hey, give me your numbers, plug in the numbers, try this, try that, and then hasta la vista, see you next year, kind of thing. For me to even show you guys, like before even hire you guys, or you hiring me, sorry, or have an engagement, that's what I meant to say. I have to also see a few things in there. So yes, I do have a lot of high net worth clients, of course, but at the same time, I have clients who are just starting as well. And one of the biggest things I look for in a client is, are they passionate about their numbers? Do they give two shit about it, about their own stuff? Because I find there's a lot of people who think that they want to be serious about their money or claim that they want to be serious about their money, but their actions don't speak that way. And, part of the thing I'm going to be talking about today is the mindset. And for me, mindsets are very important. Sometimes, I don't like taking too many examples, but, there are a lot of examples we have where we took clients who were working full time to me pushing them for a couple of years. And after 2 years, they say, okay, Hashim, fine, I'll start a small business. Right? From there, in a few months from there, showing them at what time they should be leaving their job, to when they should be incorporating, to getting their first location, all that stuff. I look for people who want to make changes in their life. So, having high profile net client doesn't mean anything to me. If you're serious about your money, I'll be serious with you and getting used, where you want to go. So I think that's one of the big things I want to talk about our practice over here. But at the same time, people ask me, like, Hashim, what makes you different? what makes your team different. And, you know, I sort of sum it up in 2 words is one is relationship. We're a relationship-based firm, and at the same time, we are an continued education-based firm. You know, even on our own end, we run workshops throughout the year for very different topics. I know Marie, for example, you have recently probably seen some of my workshops as well. So, you know, I'm all about relationships and education. So without further ado, I'm going to start talking so on my actual content today. Give me a second. Tammy, can you confirm if you can see this?
Yes, clear.
Okay, so throughout the presentation, everybody's going to be like, okay, Hashem, how do I contact you? Best way to contact me is my email at the bottom. Send me an email if you want to, you know, learn more about something, or you want to talk to me about your finances. Anybody who's coming from Christian and Tammy's teams or referral, they will get a free consultation from me. So, you know, feel free to reach out to me. So today we're going to be talking about frequently asked questions around taxes and direct sale businesses. Some people like to call it MLM. Some people like to call it network marketing. You know, close enough. We're talking about a similar industry. Okay. Yes. 2 days ago, actually, I met somebody who I said network marketing and direct sale, and they're like, "Oh, it's so different." And I sort of understand in certain businesses, it is a huge difference in there. But you know, the way they work in essence around, especially if I should say from a tax perspective, you know, they're close. And we're going to talk about a lot of things today. And I'm gonna do my best to finish in, so it's right now 8:12 EST. So I'm gonna try to wrap up my presentation by, let's say, 8:45, and then we'll have a good, you know, 15-20 minutes of Q&As. And if we need to stay longer, we can stay longer as well. So a little bit about us, already told you, relationship, education. Our main office is based out of Mississauga, Ontario. I have a wonderful army that works with us and have been working with us for a very long time, and clients absolutely love. Talking a little bit more specific about direct sale businesses, my first introduction with direct sale businesses was in end of 2015. Everything before that time, I used to call it witchcraft, crazy women coming to the office trying to sell lotions and potions and all that stuff. And I used to make so much fun until that one particular day. And that presentation, quite frankly speaking, I was actually forced to sit in there. And, you know, there were few products that day. And I was like, they work. These are better products than anything else like I've ever seen or heard about it. Because I experienced it, and that grew my interest in this particular industry. And I started working with a lot more direct sale businesses and started finding some of the challenges they were finding with their current accountants and overall, because people, I would say, you know, we're in 2023 and that's coming to an end. And people still don't know what this, some people don't even call this a business still. And then I'm like, you know what? I don't know what to say to you. I can only try to educate you guys. So, you know, a lot of topics I will talk about today will sort of help a lot of builders in here, because I know when I was pushing, you know, some of my direct sale businesses, you know, I was meeting people and people just didn't know. Okay, the number one question was like, okay, fine, if I make this few $100 more or $1,000 more a year, how do my taxes change? Oh, I don't want to do this because, oh, I'm going to pay more in taxes. Or, you know, questions like that. Or do I need to register a company? Do I need to do this? What about HST, sales tax? All that stuff. What can I write off? So we're going to talk about some basic concepts over here today. Again, this is not a bookkeeping workshop. I'm going to talk about some of the things like, you know, how to write off everything. I mean, I personally have said this so many times. As a direct sale business owner, you should be writing almost everything. You should be writing off your lifestyle because you are a product of the product. So you are a write-off. Now, there are certain things, of course, you can't write off, and we're going to talk about how to make more of those things legitimate write-offs, and that's where the mindset comes in. We'll talk about, do you need to register a business? What kind of a business you need to register? Why I'm so passionate about, and I talk so much about being sales tax registered, because people leave so much money on the table without being registered. Tax strategies, what's the best time to leave your job? What are the benefits of having a small business? Now, I know probably most of you guys hearing me for the first time today, already are in business and, sort of understand this, but I will share a few topics over here that will help you close more business and build your organization, have that edge when it comes from a tax side, so you can explain people, okay, why from a tax perspective, why is it so important to have a small business? And I really emphasize people on that, and we'll talk about some deductions. People say, oh, well, if I write off my home office, I'm going to pay taxes when I sell my house, or how do can I write on my card? Like, how does that work? And then courses. I know people in this industry spend so much money on courses. We'll talk about courses, bonus stuff. Like, I'll show you guys how to write off your furry friends and kids today. So we'll definitely have a Q&A session towards the end. So please, please, please line up all your questions in the chat. I will answer all your questions towards the end, but let's try to get through the most of the content today. So let's take a look at a person who doesn't own a business. Okay, and I share this example so people, when they talk to their teams, can pretty much give this very quick snapshot that what it means to be in a business. So let's say there's a pen, 70 cents listed at Walmart. Okay, so if I make $1 at my job, the question is, can I buy this pen? Just by the optics of this thing, somebody will say, well, Hashim, looks like for sure you can buy it and you'll have 30 cents left. And I say, no, that's not, I don't think so, because your employer is going to hold 30% tax off it right off the bat before you get it in the bank. So you get in the bank 70 cents. Oh, well, yeah, now you can buy the pen. And I say, no, you still can't buy the pen because you're going to pay taxes. Your sales taxes kick in at that point, and you have not enough money left to buy this pen. That's an effective 39% tax rate. See, a lot of people don't realize how much money they pay on their taxes. And it's important to understand how much you pay in taxes, because, and I tell this to almost everybody I meet who just has a job. And I tell them, take a paper and pen and just total up all the tax that you pay in the year and compare it to what your gross salary is. If you don't puke, there's something wrong with you. Because an average person, even me, looking at numbers for this long, this many years in my life, where here are gone from here and now they're growing on this side. But it's disgusting, and I find it quite criminal. But again, we can't change that. We can't change income tax laws. But let's start talking about why. So definitely, here's an example: 39%. Starting a business changes this. So let's say you make $1. Now you're in a business, you're going to buy the pen. You have 21 cents left. You're going to pay taxes on the 21 cents, because as a business owner, you pay taxes after writing off all your expenses. You're going to get your sales tax back, and your disposable income is 21%. Your effective rate on taxes drops down to 9%. And a lot of you will be like, okay, Hashim, we've heard about provincial rates, we hear about federal rates. I, as an accountant, get confused on those rates and those tax brackets. I look at effective rates. Okay, what effectively is coming out of my bank, out of my check, right? If I made $100, I'm getting 70 cents in my pocket. That's 30% effective tax rate for me. I don't care what the sales tax is. I don't care what provincial is, what's federal, what's carbon tax, la-di-da-di-da. We don't care about it. It's what's coming, and we're here to save whatever's coming out of the account. So let me go back over here. Why having a business is so important? Because, and sometimes as I go in these conversations and I talk to people, and it's like, okay, yeah, you can write off this, you can write off this. And you're like, Hashim, how is that even possible? And I explained them something that most people just have never heard before. Some of you might have, but most people haven't heard this before. And that is, i.e., that our Canadian or US or most of the Commonwealth countries, even Australia, our tax systems as a whole are reward-based tax system. What do I mean by that? What I mean by that is you're rewarded for taking risk, right? We have these capital gain exemptions. We have, so investors get so many, like dividends, for example, you pay less taxes compared to interest income, and so many other things. And you're allowed to write off this stuff. And people like Hashem, doesn't how can I write off my car? I already had a car. How can I write off my home? How's you showing us how to write off so much stuff, even legally possible? And you know what? CRA allows you to do this. And the reason why they allow you to do it is because any small business is the backbone of any economy. Go anywhere in the world. Small businesses are the backbone of the economy. Like, what can a person who's employed possibly at the most do? You bought your TV, you bought your car, you bought your home. You're just going to eat grocery. But a business owner is employing advertising services, left, right, and center, buying supplies. It's creating so many jobs. And guess what? Jobs created means the government's making taxes anyways. Right? So don't feel sorry for the government, right? They're rewarding you for taking risk. Now, as I talk about that, I also want to mention about some really interesting concepts, because a lot of times people get swayed away in this conversation and start putting themselves in trouble with their tax authorities. And in that, we have to understand what an active business is. So let's talk about that over there in a second. Okay, and I'll come back to the other slide in a second. So one thing I tell everybody, if you want to learn anything from me, learn the mindset. Everything else, you can mostly find it on internet for the most part, if you dig deep enough. Okay, you can call your tax authorities and they can give you better information on it, or at least guide you in the right direction. Sorry, I'm stopping this screen share because I want everybody to focus on this. So tax authorities, and this is very similar, and I'm going to talk specifically right now, CRA, which is the Canadian side, and IRS, which is on the US side, both have one thing in common, that they say, in order for you to write off an expense, you must be an active business. Take a note of this, active business, and you must have the intention to make a profit. Must be an active business, must have the intention. Okay, without this, the whole writing off stuff doesn't work. Okay, because this is so important for especially new builders, right? Many people don't realize that they have to operate an active business in order for all that stuff I'm going to talk about today, for it to work. Let's say, for sake of argument, all of you raise your hand if, and I know most of you have your videos on, if you've heard if you show your losses for more than 3 years, you're going to get audited. You probably heard it somewhere, right? Okay, let me show, let me put some, there's a method to this madness. Okay, it's not 3 years. It's wrong. Let me break that myth over here. What we're dealing with over here is something called the concept of active business. The active business is defined with $1 of income and the intention to make a profit. Okay. So two very key concepts I'm talking: $1 of income and intention to make a profit. If you haven't made your first dollar, you're not in active business. Meaning you cannot write off all that stuff as current year expenses. I'm going to layer another concept in this. Both in CRA and in IRS, they have this particular concept which says any costs associated in order to earn your first dollar of income is considered a capital cost, meaning you have to depreciate it as if you're buying an asset like a building or something, whatever, rather than fully writing off in the year. So it is so important, as soon as you sign up a new builder, push them. Please get your first dollar of income. Don't wait. Oh, I signed up now. Now I'm going to take courses. I'm going to build my inventory. 6 months later, I'm going to go to the convention, and a whole year goes by. You haven't sold anything. You're leaving money on the table. Don't do that. You gotta make your first dollar of income, even if that means the initial order that you got, you sell it to someone that you know, invoice them, get an e-transfer, whatever, get a paper trail that yes, now I've made that $1 of income, I'm in active business. Kipish, so far? Okay, that's the first criteria that has to be met. The second criteria that has to be met, that is the intention to make a profit. Now, I hope everybody who's listening to me has the intention to make a profit. No, and if you are going in business to make a loss, talk to me, because you're most likely doing something really wrong. Okay, you should be going in business to make a profit. Okay, so coming back to the 2-3 year, 4 year, whatever people say that, hey, you're going to get audited after that. What is the concept behind it? What the tax authorities are doing is there's a concept called reasonable expectation of profit clause. They call that in Canada. There's a similar word they have in US for that. But generally speaking, this is what they're trying to do. They're trying to determine, is this person going to be profitable ever? Now, let me show you a couple of examples and you'll know exactly what I'm talking about. Somebody makes $500 in the first year in revenue, has $10,000 loss. Fine, they're gonna fly. First year of business. Second year, they made $800 and they still had $10,000 of loss. Okay, bad luck. Third year, $700 or $1,000 in revenue and still $10,000 of loss. Boom, audit. And guess what they're going to actually be hammered with? They're going to be, they can have the best records of all time, but most likely the auditor is going to try to push them on this particular thing. That is, hey, you're not, because you have a full-time job, you're not, and you don't have formal education, because CRA also doesn't think direct sale businesses are a real business. They sort of assume if a realtor has to take a course, if an accountant, he has to go through the CPA program, blah, blah, blah. So what is a designation for a direct sale business person? There's none for the most part, right? So at least in the eyes of the tax authorities, they're going to say, well, you lack credentials, you're working full-time, you're not giving the business the right attention that it needs. So we're going to say, this is not a business to begin with. We're going to take your business revenue, move it to other income, and disallow all your expenses, even if they were all legitimate business expenses, just because you failed the basic definition of an active business, that is, a reasonable expectation of profit in there. Your business, the way you're running it, is never going to be profitable. Hence, we're not going to allow you to do it. And I laid quite a few concepts in here where, like, why, like, we have to understand it's a reward-based system. They're rewarding you to take risks. They're giving you refunds by allowing you to write off losses, but there is a method to the madness. So there is no 3-year rule, by the way, everyone. What they're really killing you on is the fact that they don't see your business to be profitable ever. So they're not going to unlimitedly give you write-offs and allow you to, get massive refunds. They allow you for a little while so you can grow your business. But let's take a look at another example. And I've seen this. I know some businesses who have been in loss for over 10 years, not even single time been audited by CRA. But this is what their story looks like. First year, $500, $10,000 loss. Next year, $10,000 in revenue, $20,000 loss. The following year, $50,000 revenue, $100,000 loss, still not being audited because they see the top line is significantly growing. And their system tells them, and they know it, it's common sense. For anybody who's building the business actively, no matter what the tail end looks like, if your customers are going up, which means your business is growing, your top line is going up. Right? That's where most people get into trouble. So, and I'm sort of, I typically don't cover this in my Payless Tax workshop or something like that. I'm going a lot in detail over here for you guys, because you have new builders below you. Okay. And these questions come up all the time. And you will hear people get in trouble all the time because they overlook the basic notion behind, hey, Are you even an active business, or is this a hobby? If you're building this actively, right, and it doesn't have to be full-time, right? It can be part-time, right? But if it is a hobby, try not to claim too much in taxes, like in your expenses, because large losses will trigger an audit and you probably won't go nowhere with it. Okay? So let's go back to the slide over here. So what's the secret recipe for a write-off? And the secret recipe for a write-off is intention plus action is equal to a write-off. And I'm going to go in very quick examples over here, but keep this in mind. If the expense does not fulfill the equation, it's not a write-off, period. If your primary intention to do something was not business related, even let's say you went to Vegas to gamble for personal reasons, but you met your biggest builder over there, you cannot write off any expenses to Vegas at that point because your primary intention was for personal purposes, even though you had business action taken in there. So in there, I want everybody to know one thing. If in an audit, you can prove, as long as you're an active business, any expense, if you can prove them that the primary intention was for business and there's actually business activity happened in there, it's now a write-off. A very quick example, a very basic one, is going to a grocery store, your local grocery store that has a notice board outside where people put their business cards. If your intention to go there is to do groceries, you happen to see the notice board and then put a business card up there, your mileage is not a write-off. But if your intention to go to the grocery store or that store was to put up a notice board and you happen to do groceries, nobody needs to know about that, you're now able to write off the mileage back and forth because you did the intention and your action was there. You know, traveling, right? You're gonna go see your relative or something in a particular, or a vacation with family. Find a convention that's going on over there. Come on, like this is the beauty of direct sale businesses, right? They're global. There's something happening somewhere. Align your trip according to that. Book, establish your intent that, hey, I want to go listen to Eric Worre. Fine, I booked the tickets. Now I'm going to book my hotel, my stay, everything around it. Can you have some fun during that time? Absolutely, yes. Right? But you have to establish your principle and your primary intention all the time that, hey, intention, and always remember, intention, you can't just unlimitedly intention your everything. There has to be action in there as well. And for as long as you're able to prove intention and action, you have no problem. And we'll go over some examples today to further discuss this, okay? So develop a habit before you leave your house, before you pull out your purse for your credit card. Stop and think, how can this particular action, and I'm very carefully using this word action, I'm not using transaction. How can this particular action be related to my business? This is the mindset I want everybody to leave here today with, because this is the key. You cannot even be in a relationship or drive a car or anything without the right mindset. How can you be financially free, the so-called financially free, which I personally, financial freedom, I like to call one of the world's most prostituted words out there, because it means nothing. And I add to that is there's no financial freedom without an effective tax strategy. You can make whatever on earth you want to make it. Guess what? You're going to start paying more in taxes. In Canada, it's 53.5%. On top of that, you're going to pay carbon tax, you're going to pay HST, you're going to pay property taxes and tax this and tax that. Right? So by the end of it, if somebody's making $1 million, they're really just using about 350 of it. And that goes to Living to Jones. That's a different conversation altogether one day. Okay, so let's talk about Bunny. Okay, so Bunny has recently passed away, but Bunny is a name of my late fish, and I had it for a very, very long time. And the question is Bunny, or was Bunny, a write-off? And the answer to that question is yes. Now, this story actually goes back to 2015. I was being questioned by CRA, and they're like, okay, so, number of things, and I kept proving intention and action, intention and action. And the auditor was really frustrated with it. And then, he thought he found, something that he can really shine on and be really happy about and go to sleep that night really well. He's like, okay, so Mr. Chaudhary, tell me one thing. How does $500 of freshwater fish relate to your business? And I was like, okay, hold on for a second. Apart from being an accountant, I'm also a fish enthusiast. Okay, I go to these exhibitions all the time. I keep competition fish, and I go by, and I like checking them out. I'm just fascinated by these creatures. So when I go to these events, one of the most common question I get asked, or I ask, is like, what do you feed them? What's the what temperature you keep them? How often do you clean your tank? La-di-da-di-da. And then while I'm doing that, me being sneaky as I am, I will always ask this question to all these younger crowd. It's like, hey, listen, by the way, do you know all this equipment that you have, you can write off? And they're like, huh? The sales tax, you could get it back. It's like, huh? Your water bill, you can write it off. It's like, huh? I'm like, yeah, we need to talk. And then guess what? They book an appointment and they come to my home office. And over there, I have a beautiful tank. Guess what? They see the fish. It opens conversations. That's number one way how it helps my business. Number two, the sound of water is scientifically proven to calm people down. People are scared to talk about their finances and taxes. It calms them down. And then the third reason, it keeps the kids busy while I talk to their parents. And that's why bunny's a write-off. And I was like, it's not a fish, it's called bunny. And he's like, okay. So I still remember it was a good few 20-30 second pause. And he's like, okay. And I'm like, okay. So he knew from there on that, you know what, this guy knows what he's doing. So can you write off your friends, your furry friends, your cat and dog? Possibly, but can everybody do it? No, there is certain protocols, certain ways it has to be designed. Can you write off 100%? Some cases, half of it, sure. But please talk to your accountant who really understands these things, how they can relate your furry friend to your business, right? So many of my clients, I have converted their dog into a business write-off. Why? Because they're in certain industry where they can bring their dog around, right? So the kids can stay busy, or at construction sites, right? They can show that this is for their safety, and so many areas where you can do it. So if you have a furry friend that is somewhat related to your business, is a mascot or whatever, give me a shout. I'll show you how to write it out. Okay. So let's talk about some fun stuff. So telephone and internet. Okay, so definitely everybody knows telephone and internet can be written off. But one of the biggest areas where I find a lot of people do their mistakes is they list this under their home office category, and home office category claim is usually lower than if they were to put it at a prorated rate under direct business expenses, and they can claim a higher percentage. Now, point to be noted over here, please do not claim 100% if you only have one cell phone. I find in most audits where I used to be doing them, and when I'm dealing with them now on the other side, I came to light, is the challenge around people just put 100%, tell them 100% this. Well, as an auditor, this is the number one question I used to ask. Is like, hey, I know you have kids, and you sound like a business that's continuously on the road. Now your kids go to school. If the school's calling, which number do they call? Oh, they call my cell phone. Aha. So it's not 100%. And this is how sneaky tax authorities are. And this actually is a method that is shown in our audit manual on how to catch people on this. And I would say, you know what? Okay, now I know it's not 100%. So what I'm going to do is I'm going to make it 0% for now. Go look at each phone statement in front of each text, each call. Write down the names of the people you sent it to, and how did that call relate to your business. Good luck doing that. So you're better off using a prorated method, okay? Go with 50%, 60, 80, 90%. You have to be able to, show them very easily what percentage it is. Now, I have two cell phones. One cell phone's on my business card and things. That I write off 100% because no personal contact has that number. And I have my own personal line, which is usually around me the most. The other cell phone is just forwarded to this one because that's a cheap phone. This one is my main phone on which I do, but this is I also use it for personal purposes. So I only claim this 50% and the other one 100%. So, you know, take a look, a realistic look. You got to be able to explain it to an auditor in a quick phone call and convince that person. If that person is not convinced over a quick phone call, they're going to burn you. Home office. Okay, it has to be a designated place. Okay. One question that I get a lot of time, Hashim, if I write off my home office, am I going to pay taxes when I write off when I sell my house? The answer to that question is it depends. To what percentage you claim your house, okay? And this is where a lot of people do their mistakes. So I know this one of my clients, she was doing her taxes somewhere else, and first time came to me back in 2015, and she's like, "Yeah, Hashim, I've sold one of my properties last year." And I was like, "Ooh, okay, tell me a little bit more about it." And I'm like, "You're going to pay a lot of taxes on it." She's like, "What do you mean? Why am I going to pay taxes on it?" I'm like, "Well, at the basement, you were renting it. Main floor was your clinic. And on the top, you were living. So 2/3 of your house was used for business." And she's like, "No, that's not how I see it. One was rental income, one was business income." And no, that's not how the tax authorities see it. It's the percentage of use of home for business activity, combined business activity, and personal use. So for as long, there's a concept of principal residence. In other words, you don't pay taxes in the house that you live in. So you're allowed one property. Your second property is definitely going to pay capital gains on it when you sell it. But this one property you're allowed to. So for as long as 51% of your house is used for personal purposes, you're not going to pay taxes on it. Try not to go 49%. Try to cap it off at 45, 40%. You know, if you and your husband work from home and you have basement rented out, first total up what the total percentage works out to be. By the way, there's an interesting thing I tell a lot of people as well. If you live in that house, even if 2/3 of the house is used for business purposes, don't claim it as such. Because that little bit of tax that you save every year is going to cost you a lot when you sell the property. So always claim that 2/3 or, you know, at least 55% of the house was used for personal purposes, even if it's the other way around. You live in one room and the whole house is rented out. Okay, save yourself the big bucks in taxes. Of course, you can write off your heat, electricity, water, mortgage interest, rent, you know, even landscaping. If you have clients coming, a lot of direct sale people, they have their clients coming into their house. So if you need to put flowers, you need to make the house look pretty, you're able to write a lot of those things off. Now, I don't want to go too much in detail because my bookkeeping workshop, and I think we'll do one soon over there with Christian and Tammy as well, and we'll go more in detail. On what specifics more stuff you can go in there. Meals, entertainment, it's a category that you only get to claim half of it, okay? So it has to be 2 people minimum on the receipt. It's not your coffee on your way to work, okay? A lot of people do a mistake on that. At least 2 people need to be on there. Tips are not a write-off. Tips are only a write-off when you don't have an option, okay? So in other words, if you enter tipped manually afterwards, that's on you. It's not a write-off. But if tip was added in the bill, so do it like Hashim. I don't do like this from far away. I first call and I say, "Please add 15% in there." Or you can do it after. No. Put it in the invoice. Because when you put it in the invoice, this shows the tax authority I did not have an option. I had to pay it, therefore it is a write-off. Otherwise, it's not a write-off. I know you cannot sometimes always do it, but keep this in mind. The other thing what you need to keep in mind is please, I beg everyone, do not give people Starbucks gift cards or restaurant gift cards or movies gift cards or concerts gift cards or tickets. Please don't do it. They all fall under meals, entertainment, and you can only claim half of them. If you need to give people gift cards or something like that, or take, you know, things like that, give them Visa, MasterCards, give them Walmart, Home Depot cards, whatever, things like that. Anything that, even a gift card in that category, goes in there, you're only going to get claim half of it. So please don't leave money on the table. Mileage log, yes, you need to claim, keep a mileage log. You know, on vehicle expenses, we'll talk about sales tax very quickly. You can get back the sales tax on the purchase or the sales tax that you're paying on lease if you're sales tax registered. You can depreciate your vehicle and things like that. Always talk to your accountant before you purchase a vehicle. Don't say, yeah, I'm picking up the car tomorrow. What should I do? No. Before you decide which car you're going to go with, call your accountant. Okay, what are my options? What do you recommend? And then pull the trigger. Trade shows you can write off. So, everything from trade show, going there to hosting it, entertaining staff, everything you're allowed to write off over there. Accounting fees, you can write off Hashem. Now let's talk about costly kits because most of us have them. In US, each state has their own age, but on average, if you want to look at it, in Canada, it's 12. In US, it could be 12, 13, or 14, one of them, okay? Check your local authority, but you can hire your child as soon as they turn 12 years old on payroll, not as a subcontractor. And you can pay them up to $15,000 and the kids will not pay any tax on it. Not even CPP, EI, or anything like that, because they start paying it once they turn 18 and what have you. So, but you get the deduction on it. So if you have kids who are 12 years old, you need to give me a call. I'll show you how to write them up, okay? Now, the big stuff, monthly orders. So this is for a lot of new builders over there. So I know I'm going a little bit over time, so please forgive me. I know I usually get swayed away from with many topics, but try to wrap it up in 5 minutes. So monthly orders. Yes, you can write off your monthly orders. Absolutely. And the logic behind it is for most businesses, I've seen some businesses that are not in that particular format, but for most cases, when we say monthly order, that's your monthly commitment. And if you don't pay that, you don't get commissions, right? So this is known as cost of doing business. So if you're ever being questioned, like, why are you writing off these orders? The only answer is, this is the cost of me doing business. If I don't pay this, I don't get commissions, number one. And all the product that I get is used for product sampling and giveaways. That's it. Do you use it personally? No. This is my cost of business. All products I use for sample. Just zip it over there, because it's like the more you talk, the more you're going to dig your hole on there. Okay. I know most of us use a product in some ways ourselves as well. If you're somebody who orders a lot, then maybe keep a 5%, 10% buffer that, okay, you know what, this is my personal product, and write everything else off. Okay. But your monthly orders definitely should be by and large rewritten off if you're building the business actively. Clothes can only be written off if they fall under the uniform category or you are a performer. Okay, so there is no other way to write off clothes. A lot of people try to argue with me, oh Hashim, I am in this industry, I'm a lawyer, and I need to look like a lawyer with black suit. Okay, does it say your company name on it? No, that looks awkward. Okay, then it's not a write-off. The only time somebody can write off their clothes if there's somebody who either gets a permanent emboss done on their clothes, so it's a uniform, or the other way, the only other way around it is you're somebody who gets on the stage, performs. So ladies, if you get on the stage often and you do presentations and stuff, so for that particular day, if you need to get your nails done, your nice shoes, your purse, your hair, makeup, all that stuff, write off. Okay, because now you are falling under the category known as performer. Okay, so you have to meet the performer category in order, and please be really logical in this whole fashion. Please don't just go buy your whole wardrobe and write it off, because that's going to be trouble. You know, a normal business person, 2 to 4 suits a year, that's reasonable. Okay, if you push it too much, you're going to be in trouble. Okay, so let's talk about professional development, because most professional development courses fall under the asset category. And what does the asset category mean? It's something that has a benefit of greater than 1 year. So if you're in business where you have to take a course in order to stay compliant, no matter how much you spend on it, that's current cost. But if you're going and taking some of these Tony Robbins course, like for example, Business Mastery, classic example, I'm sure almost everybody's heard about it. Tony Robbins Business Mastery course. That's a really expensive course. You guys should go. It's lovely. But first read the books. Anyways, if you do get a chance, do go there. It will change you. Some of the programs Eric Worre has, take them. They will change you. You will not come out of them the same way that you went in. But these are courses that are asset class. They're going to benefit you on a number of years, and they're over $500, meaning they need to be depreciated. Okay, so a lot of times I hear this, oh, Hashem, I made about a couple of $100,000, but I spent almost 100K on courses. I don't think so. I'm going to pay taxes. I'm okay with it. And I'm like, honey, you're going to pay taxes. And they're like, what do you mean? Because let's take a look at what courses you took. Right? Because if they meet the asset class, they have to be depreciated. So a lot of people making mistakes over there, especially in direct sale businesses. So if you're taking a big ticket course, talk to your accountant. Ask how it's going to be impacting your taxes before you make up your mind in terms of what you're going to spend on it. Coaching, of course, coaching is like professional fees. You can write it off. That's a different thing. I'm talking about courses which are asset class. So professional development. Furry friends, we talked about that. Spotify, iTunes, I share a very funny example. Just before COVID, I was in Peterborough presenting. It was about a couple of hundred people in the stage, on the audience there. And there was an older gentleman who was just going before me. And he was playing music in between his sessions from YouTube. And by that time, the YouTube ads and everything was all up, and everybody knew what kind of blue pills he was eating and shopping around for those days. So please, if you're going to be playing music, please get licensed music. And luckily, if you have Spotify and iTunes, you listen podcasts and stuff like that, that's all a write-off. Paid music is also a write-off. A lot of people don't know that as well. And if they mostly have these subscriptions, but just don't use them. Okay. So let's talk about, do you need to register a business? Both in US and Canada, you do not need to register a business in order to do your direct sale business. You can do it on your personal name. Okay. You can choose to register, but you're not required to register. Okay. So a lot of time people spend a lot of money up front, talk to your accountant or your legal team and see which business structure suits you the best. What is the best time to incorporate my business? And what is the best time to leave my job? Well, the best time to incorporate your business is when your net income is coming to a level where your personal income, it costs you more to, for example, your corporate rate is lower than your personal rate. So let's say, for sake of argument, because I'm trying to not give a generic number, because in US, the number can vary a lot. But in Canada, we typically look at around 50K. If you're making 50K net income for personal taxes, after all expenses and stuff, you should consider incorporating if you have exhausted all other ways to lower your taxes. But in US based, because some have provincial rates, some have federal, some have both, that varies, and, contact us and I can let you know if it makes sense for you or not. But corporate rates, a point comes where it's cheaper to have, but a lot, and I know this, and I'm going to say this over here, and a lot of people listening to this might not like hearing this. Most speakers, these big speakers, they often talk about, get incorporated from day one. And I disagree with that so much. There's timing on this because incorporation costs money. Okay. And a lot of times, if you incorporate right off the bat, you're going to lose so many. Whoops, what happened there? Okay, we're back on the screen. If you incorporate too soon, you're going to leave so much money on the table. Let's take a quick look over here. Back on this one. Okay. And this is where I'll talk about what's the best time to leave your job. So let's say, and this is an example based in Canada. So tax rates might be different in where you're listening to. So let's say if you make $100,000, you're going to pay about $27,000 in taxes. Your first year, let's say you make a few $100, but you had $10,000 in expenses. Just to put things in perspective, an average Canadian spends over $10,000 on vehicle between depreciation, car payments, and all that stuff every year on their car alone. So this $10,000 number is very easy to achieve. So let's say you have $10,000 in losses, your net income drops to 90, your taxes, you're gonna get about $4,400 in refund. Get sales tax registered, your refund's gonna go over 5,000. Right? If you were incorporated, your corporate losses are your corporate losses, they don't generate any refunds for you. So the best time, and coming to the topic over here, what is the best time to leave your job? The best time to leave your job is once your business is earning enough that you can sustain yourself, and you know that now if I go full-time, I can very easily replace my employment income. I will tell you, and I don't want to discourage this, and I have to speak as an accountant rather than a builder, is I find 95% of the people who you meet in your networking who say, I left the corporate just to be broke. Let's be very honest on it. I know their numbers in the back end because I network a lot and I have lots of clients. I can't take names, but I will say some of these big people, they're broke as hell and they're paying to be on the stage. Okay, and it's a big show, this, that, and that. Please don't be like that. I'm talking true numbers over here. The best time to leave your job is once you reach that point that, okay, now I can leave this. The best time to start a business is when you have a job. And this is why. Can this $5,000 build you a brand new website? Can it buy you new equipment? Can you get a new laptop and some office furniture? Absolutely, yes. So the best time to start your business is while you're still employed. Get into active business, get your $1 in as soon as possible. Buy your laptop, website, blah, 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 whatever you need to buy. Take your courses as soon as you become active. Maximize this $10,000, take it 20, 30, get all those refunds back. Because once you're incorporated, your business starts doing well, you're incorporated, you don't get refunds anymore. The way you get over here. This 5,000, I talk about it, and I call it free money. Okay, please, please, please don't leave free money on the table. Okay, so this is the best time. So if people ask you how it's going to impact my taxes when I first start doing this business, you're going to get this much in refund. Tell them that. And if they still don't get it, give them my number. I'll explain them how. Okay, so with that, sales tax registration, last topic very quickly. In Canada, in most provinces, we call it HST. So that's that number. So if you're hearing that. Canada, it's 30,000. State, it can vary from state to state, but anywhere in the world, for most countries, if there's always a threshold point at which you are required to be sales tax registered, you have no option beyond that time. I tell people the moment you're active in the business, register it from day one. And the reason why I say so, because you spend so much money on sales tax left, right, and center. And by not being sales tax registered, you're just leaving money on the table. Okay, so how it works, it's collected minus paid. So your first year, let's say if you only made 1,000, you collected $130 in sales tax, but you paid $500. The government's going to say, well, you owe us $130, we owe you $500. Keep the $130, we're sending a check for $370. That's money on your back in your account, dollar for dollar. And then let's say your business grew next year, you made $10,000. It's $1,300 now that you collected. That's not your money, but you paid $500. The government's going to say, well, you owe us $1,300. We owe you $5. Just send us a check for $800. So you're always in plus. Don't leave money on the table. I mean, I remember when I bought my Tacoma back in 2019 in December, and I filed my sales tax return in January. CRA sent me flowers and chocolate, a box of chocolates, and $3,900 back in check, and said, Mr. Chaudhary, we're so happy that you got yourself a beautiful truck. Here's money for rims. Buy rims and claim it again. And we'll send you another check. Okay, so please, please, if you can be sales tax registered, be sales tax registered. And sometimes people will say, well, I work for a US company and I'm in Canada or in another country, I don't get paid sales tax. There's something called zero rated, and we'll do another whole workshop on that. I don't want to go too much. I know it's 8 o'clock. It's 9 o'clock now, Eastern time, and you guys are in the evening. I know it's a lot of information I'm giving, but we will do those topics in a different workshop on how sales tax works for businesses. And with that, Thank you so much. I know I took a lot of time talking about the active business and stuff and how the losses and stuff, but I feel that that's really important topic when it comes to direct sale businesses. And almost everybody has new builders who are in that situation. And it's important for you leaders to educate them and let them know, hey, talk to your accountant, because if you're not building this actively, you need to treat this business differently. Okay. So with that, thank you so much. My email again is at the bottom, and I'll take a look at the questions now. Okay. Thank you. If you have questions, okay. Marie, Hashem, can you talk about the fact that we're paid in US by American company? We are supporting the Canadian economy. Can you please expand on that? Okay. Oh, it's gonna, how do I keep it precise? Okay.
A short version.
Yeah. It's, business income is business income. If anything, the Canadians love foreign currency coming into Canada. Okay. So if anything, they're happy about it. What I do want to talk about is sales tax now in Q&A, so we can, I can explain a few things a little bit longer. If you're a Canadian distributor who is working for a US based company, you can still write off the same stuff that you can write off for as a Canadian business. There's no limitations. The biggest challenge that you will run into is around sales tax. And you always have to ask this question is, let's say if you're in business of staplers, right? Okay, sorry, this is the first thing that I saw in front of me. And you're buying it from US, okay? Or you're selling it to US, you're not going to get paid sales tax, right? Because you can't charge them sales tax. But the question is, if you're selling the same thing to a Canadian in Canada, right? And by the way, this is the same thing other way around. If you're a US and you have a Canadian business, whatever, okay? Because cross-border, you cannot charge sales tax. So the question really comes down to is like, if you were in your own jurisdiction and you sold it to someone, would you have charged sales tax on it? And if the answer to that is yes, then most likely you're in a zero rated category. And I find so many direct sale businesses leaving so much money on the table like this because, I want to take an example, send out cards, for example, if you guys heard, it sort of went away. Classic example, I've shared it so many times. If you had to buy greeting cards in Canada, you would have paid sales tax at Hallmark or Walmart, wherever. But it's a US based company, you don't get paid HST. Well, the government Canada says you're zero rated, meaning you don't collect anything, but you can still claim your sales tax and be sales tax registered and get those refunds. Okay, so please, please, please. I think between all of that, I think sales tax is the biggest topic I wanted to talk more about. I think as we do some other workshops, maybe we can have a presentation just on, what does cross-border taxes mean and what does it, because there's some direct sale businesses in which people have Canadian teams and some people have US teams or international teams. And because they have registered entities, the main company has registered entities in all these places, they get income from all these places. So treatment has to, so that's where, so I have a workshop on tax residencies and cross-border transactions. I think there's another one happening in January or something like that. So we can do one just for direct sale businesses as well and go a whole lot more detail in that, Marie. Can I hire someone else's kids? Of course, Marie, we can definitely hire. That's, easy. Linda, what do you recommend for a write-off of product costs? We are required to order 100 USD. Everyone, however, I understand we cannot claim it. Of course, if you're required 100K, you can do everything, Linda. So again, going back to memorize these words, that $100 is my cost of doing business. If I don't spend that, I do not get a check. And all product bought are used for product sampling and giving away and demos. That's it. That's all you gotta say. Not a word more than that. And you're good. If you perform during presentations, what about online performances? Okay, so CRA these performances are actually in-person performances, Marie, but during COVID, they have allowed a grace period. I don't know about IRS if they have given a grace period. Okay, so CRA has a grace period these days because in-person events are still not happening the way they were happening. So as long as you can logically explain that, okay, I had to dress. I mean, I'm in my t-shirt. I'm really laid back. Forgive me, guys, for that. I love talking about money. I don't mind. Awesome. Denise, terrific information. Glad you found this information, Linda. Thank you. Appreciate. Perfect. And again, my email is over here. Feel free to reach out. Marie, Max charging us 16 USD. Max has a Canadian entity here in Canada. That's why they're able to charge you HST. So I believe in Max, they directly remit to CRA and you just file your return and get your difference. So it's a different, each company has its own way. So if you want me to study your comp plan and figure out, I'll be more than happy to help you. Bill, can you claim any kilometers on your car? Let me make this a little bit bigger. Can you claim only kilometers on your car to keep it simple? Okay, so Bill, it depends on person to person. Depending on how many kilometers you drive and what kind of car you have, do you finance or lease? Yes, you can do that, but I've seen many case studies and cases where CRA will say, no, we want you to claim actual expenses rather than kilometers. And one can definitely, typically speaking, when we use mileage rate is, let's say you have a personal car that you're using for your corporation. But when there's a situation where the ownership is in the same entity, at that time, most tax authorities will force you to just claim the actual expenses rather than the mileage, because mileage rates are usually higher. So again, Bill, I have to take a look at how you're structured and then give you my opinion. Okay, I think that's it for questions. Again, something comes up again, I'll be more than happy. Again, guys, most of these answers are very generic. Everybody's tax situation is different. I would love to meet you guys in person. My email is over there. HashimC@bgaccountinggroup.com, or you can call my office or go online and book me directly from there. I know if you go online and book me directly from there, there's a fee for it. So it's best to just email me and I'll get my assistant to schedule us a meeting from there. With that, thank you so much. And I hope I didn't bore you guys all.
No, that was fantastic. If you want to maybe stop the screen share and then we'll kind of end on this note. Beautiful. No, that was actually phenomenal information. And I know there's a wealth more there. I mean, you can have a dictionary of a book, when it comes to tax details. But I think you've covered a lot of grounds and you've covered some things that were very consistent with what Tammy and I have been sharing. As you know, we've been claiming HST for years. Before that was GST. That's how long we've been doing that. So you're absolutely correct. And because we get paid in US dollars, it's deposited into Canadian institution. So we bring money from outside. It doesn't matter where it comes around the world. It's an American company paying us. So we've been doing this for years and years and years and years and years. And but there's so much more to that. So folks, I do recommend you connect with Ashim through the information that you share on this presentation. This call is recorded. It'll be posted in our channel. And then you'll be able to get it there and access it and pause it and everything else. So again, want to thank everybody. So let me just kind of share, make sure we can see everybody here. And I know we took a little bit more time here, folks, but this is so important. And Ashim has a wonderful partner. You guys met him. His name is Craig Dunkley. And you'll be coming back talking to you about different areas because, when the market, everybody talks about the big boom, the balloon that's about to explode and all of these things. Remember that when the market goes down, that's when it's time to buy, right? And then when you buy, when the market is down, the world is cyclical. And this is how the rich gets very wealthy. So take advantage of that. But Ashim, thank you so much. That's phenomenal. Tammy and I are super grateful for the work you do for us. And we're grateful for how you've impacted in a positive way the amount of tax we're paying compared to before. And again, we want you guys to take advantage of all of this. So again, thank you so much, Ashim, and everybody. So
Pleasure.
stay tuned for the next call next week. We'll let you know what we're going to be covering. And again, I hope that you take this information to heart. You don't just sit on it. We're introducing you some very good resources for you to take advantage of, so you can keep money in your pocket and increase your assets. So everybody, have yourself a great evening. And again, Ashim, thank you so much. Bye for now.
Thanks, Ashim.
God bless. Bye.
Bye-bye.
Bye.